Hey, what's up everyone? This is Coldwater again from Phantom Trading, and we have another pretty cool trade psychology video for you guys today. In this video, if you haven't already guessed, we are talking again about probabilities. So I've seen an exercise similar to this using a coin flip a couple times on YouTube, and while I think that exercise is pretty cool, I wanted to take it a step further and modify the probabilities a little bit. So the problem I think with the coin flip exercise is that you're really just flipping a coin and you have an effective probability of about 50%, right? Either heads or tails. With this, the reason I've added a couple of dice here is so that we can change our strike rate a little bit, right? So I'm using a 10-sided die and a standard 6-sided die to actually, determine the amount of R that we're pulling out of a trade. Or we have to remember at the end of the day that every moment in the market is unique. Anything can happen, and there really are no guarantees, right? We can have a system, a theoretical system in place, and by system I mean a strike rate and profit factor or average R that we're expecting in that system, and things can go really great and things can also go very sideways, right? Losing streaks happen, and same with winning streaks happen as well. So the reason I wanted to do this is because as you can see here, I have my 10-sided die, and if we look at the spreadsheet that I created, which I'll actually share with you guys if you want to do this exercise yourself, you can see here that I'm considering anything that we roll from 1 to 4 as a win. So that's a 40% chance of winning, right? Which will take us to the next stage where we're actually going to look at the 6-sided die to actually determine our amount of R, right? So in this case, we're going to do just a theoretical $100,000 account. I've actually already done a little test run here. You can kind of see the equity curve that was produced out of it, right? And you can see that I'm counting a 1 on the die, right? On the 6-sided die as a 0R or break even, right? So there's now another 16.6% chance that you're going to go break even on the trade, and then an 83.33% chance that we're actually going to make R on that, and that could go from 2, 3, 4, 5 R all the way up to 6R. So again, just keeping it a little bit simple. Pretend that we're just trading, maybe the 15-minute or something. You're not shooting for super high R, and you don't need necessarily a super high strike rate, but you do need something healthy. So our actual strike rate, in the case of this little test that I ran here, was 40%. Now, of course, what I have here in theory is 40%, but it's actually modified a little bit because we have break-evens in here as well. So we're actually probably looking at something like, a 34 to 36% strike rate, maybe 38%. I'm not going to bother doing the math on it, but I think you can kind of understand, right? Unless we were winning on a 1, as in calling it a +1R trade, then it would be truly 40%. But because of this, we have break-evens in here. That obviously lowers the probability of you actually producing positive R on that roll, right? So just something to keep in mind, but obviously, there's good potential to make R here, as you can see. Not the greatest equity curve, but what I'm going to do first is just do 20 rolls here, just to give you a set of data. And then what I'm going to do is I'm going to do a full 100 rolls after I do those 20 rolls, just so that you guys can kind of see the law of larger numbers start to play out, right? Because of course we can go through losing streaks like we did here. We can also go through big winning streaks, but it should average out to in and around that under 40% mark based on the parameters that I've set here. So if this is all really confusing for you, I promise it's going to make a lot more sense when we start rolling the dice. So let's get to it. Okay, so what I'm going to do to start off here is I'm just going to clear this out. And again, I will share this Excel spreadsheet for you guys if you want to play with this a little bit. I think it's a fun little exercise to do that will help you understand probabilities a little bit better, right? Again, there is no certainty in things, right? It's the same thing with scientists, right? When they're trying to determine the probability of something, there really is no certainty, right? There's always a chance that something can fail and a chance that something can happen as well, right? So let's start with this. So starting off, we have our first roll here. We have a 1, right? So that means that we've won, right? Meaning we can now look at our 6-sided die here, and it looks like we rolled a 5. So we've made 5R on that trade, right? Okay, moving on. The next one, a 6. So for the 6, we're going to do a -1 because it was that 60% chance that we're gonna, hit our stop loss, right? Based on our trade plan and strategy, right? So I put that there, and let's keep rolling. Okay, you rolled a 7, that's another loss. I'm just gonna go a little bit faster here. 5, that's another loss. 4 and a 2. Okay, so we made 2R on that trade. It's good, we recovered a little bit, and we're still up. We rolled a 9, that's another loss. Okay, 6, another loss. See, but we're rolling potentially nice things here, right? Okay, another loss, we rolled an 8, so small losing streak. Another loss, another loss. So that's 5 losses in a row now. Okay, now we've just recovered most of those losses because we rolled a 1. Again, if we look, 1 to 4 is a win, right? And then 4, we made plus 4R. Okay, so roll again. Oops. Okay, another loss. So we're up 2R overall. And then another loss. Let's see if we can try to get, a 2 and a 4. So that's not bad. So now we've recovered all of those losses there. That's good. 4 and a 6. So again, okay, now we're starting to hit pretty nice here. An 8 and a 6. Okay, I would have liked obviously a lower number because then we actually would have counted it. We got another loss there. Okay, 4 and a 3. So not bad. Recovered a couple losses. We actually made plus 1R from our previous peak there. So that's good. New equity highs. Okay, another loss. And last one, a 4 and a 6. So there we go. Wow, look at that. So this is a pretty nice equity curve actually. Right, so imagine you take 20 trades over the course of a month, right? You start out with, a pretty nice trade at the start, 5R. You go through a losing streak, right? Do you deviate from your plan? No, because if you do, that messes the probabilities up, right? You stick to the plan. We start getting into better market conditions, sticking to the plan, and we start hitting a winning streak, of course, with some pullbacks and stuff in our equity curve. That's really fantastic, right? Now, if we look at our actual strike rate that was produced here, right? We're counting break evens, by the way, as losses, right? Break evens just meaning, you trailed your stop loss to break even, maybe covering commissions. You count it as, we'll count it as a loss in this case, right? So in this case, look, we were able to pull a 35% strike rate, which honestly isn't bad because we had a pretty decent average R that we were making, right? What I'm actually going to do here as well, I'm just going to quickly pause this and find the formula for profit factor, but I actually want to measure our profit factor as well. So give me 1 second here. Okay, so that took a little bit longer than I expected. As you can see, is a little bit of a complicated formula. Profit factor is winning probability times average profit from a profit-making trade divided by loss probability times average loss from a loss-making trade, right? So our winning probability is, this is just a mini lesson on profit factor. If you ever wanted to calculate it, though most of these tools do it, trade journals and stuff, our winning probability is obviously 35%, our actual, strike rate, right? Average profit from a profit-making trade is 4.2 something, which is basically 30, which is the total R that we made here in our positive trades divided by 7 positive, winning trades, right? And that's divided by our loss probability, which is the inverse of 35%. That's 65%, right? Times the average loss from a loss-making trade, which is -1, right? And that's how we get our profit factor of 2.31. So that's a very healthy profit factor, actually. Anything over 1, obviously, is a profitable system. 1.5 is considered good. 2 is considered great. 3 is considered, excellent. Anything above that is like outstanding, right? It's exceptional. So now what I want to do is, now that we've calculated all of that, we have our equity curve here. What I'm going to do is actually run this through 100 times now. So what I'll do for this next part is I'm going to obviously fast forward through it so you guys don't have to sit and watch, but sit and watch me do it at real-time speed. But I'm going to do that on this next one. I have 100 laid out here. I just have to edit the formulas and throw them in. And let's do that next. Alright guys, sorry, I just had to tweak the formula here a little bit. because obviously we have 100 outcomes here in our series of data, or our data set. So we can see here our actual strike rate. Remember, this is counting break-evens as losses, right? Is 28%. So there you go. You can see that obviously it's a lot lower in actuality. Our profit factor is still pretty healthy at 1.51. I would consider that a good system. And we can see that over a series of 100 trades, we were able to make about 45R, which of course compounded into about 52.76% or so, right? So you can see our equity curve here and stuff, right? Now, obviously, this exercise I think is a great way to play with probabilities and try to understand it. And you can see that we ran through a couple of big losing streaks here, right? But really, all that matters is your ability to stick to your plan, keep trading, whether you feel like the next trade is going to be a win or loss or not, right? Because you really can't control it. Again, every moment within the market is a unique moment in time, right? Again, you really don't know who's behind a move in the market. It's impossible to say, right? The outcome of 1, 2, 3 trades that you've taken has no bearing on the effect or the outcome of the next trade that you take, right? So if you hit a losing streak, it doesn't mean that you should become sheepish and not hit the next high probability setup in your system that you've proven works by looking at trades in hindsight and stuff, right? I'm sure you've developed your system by doing that, and just keep on hitting those trades, right? Because eventually it's going to play out, right? And of course you can survive losing streaks and stuff. Let's see, I think the biggest losing streak that we got here was -7. So we got 3, 6, 7 in a row, right? And look, we were very easily able to recover, right? If we look at the 64th trade, right, which would have been around here, right? From there, look, we were good, right? And this looks like a pretty realistic equity curve. That's the crazy thing, right? You're gonna have periods where you're gonna do really well. You're gonna have pullbacks in between that, or losing streaks. You may even have a period of time where you're kind of break even, right? And then you're gonna have, again, other really great market conditions where your system works really well and you're banking a lot of R because your system is very effective in that market, right? And you're able to pull a lot, right? So even if we were to look at this over a series of a year, if you're able to make 45R, I mean, you're making a good chunk of money on a 100K account. If you have 2, we're now looking at rather than just $52,000 in profit over that full year of 100 trades, right? We're looking at $104,000 in profit, right? If we have 3, we're looking at over $150,000 in profit, right? Of course, there's the profit split and everything, but you're still looking at around probably whatever 80% of 150 is, which is probably like $120, right? $120,000. So 4 accounts, then we get into the $200,000 range, right? And then again, it'd be probably something around like $160,000 after the profit split if you're doing 80-20, right? So that's just looking at it from the perspective of, for looking at prop firm accounts, of course. But again, the whole point of this video was to try to show you guys how probabilities play out, right? And we can see that it ended up averaging out, right? Now, again, our actual strike rate maybe differed from what we expected. I was expecting something a little higher, but I'm sure if I were to do this, exercise 100 times, then we'd probably see that this would even out to around 35 to 38%, right? Again, it's because we have this and we're counting break-evens that this is lower. Usually I don't count break-evens in my my strike rate. So I'm sure if we were to take them out, it'd probably be something around that, 35 to 38% strike rate range, right? Anyways, that's that little exercise. I urge you guys to, take my spreadsheet, do what you want with it. Open up Google and search for online dice roller. And you can play with the probabilities all you want, right? Just, decide, right? If you want to do a 50-50, then it's as simple as, using a coin as your first die here, or you can do, a 4-sided or 6-sided die. You can do odds and evens, right? I mean, actually, any of these dice, you can do odd or even for 50-50, right? If you want to have a higher strike rate, if your system is really good, and you're able to produce that, then great. Maybe do, a 10-sided die here, like we have here, And the first 6, you know, if you roll 1 to 6, that's a win. If you roll, 7 to 10, it would be a loss, right? And then you can change the amount of R too, right? Again, using these different sided dice, right? But anyways, I hope you guys learned something from that. It was a fun exercise for me, and I hope it helps you guys understand the nature of probabilities a little bit better. Anyways, happy trading, guys. I'll catch you on the next video.